Welcome to Breaking News to Trading Moves. Today we're looking at some sudden turbulence we saw flare up recently in the financial sector.
Yeah, it wasn't really a broad market sell-off, was it? More like a focused pressure point.
Exactly. So we're going to zero in on what actually triggered that initial volatility. And importantly for you listening, we'll detail the immediate winners and losers. Specific companies, specific categories.
And this recent event, it was almost a textbook case, Sentiment shifting pretty fast based on very localized news.
What was the flashpoint then?
Well, it was really a cluster of things hitting at once. You had some bad loan disclosures pop up, plus these allegations of fraud connected to exposures at a few U.S. banks.
Okay.
And then sort of adding fuel to the fire, there was a separate set of auto-related bankruptcies making headlines around the same time. It just created this potent mix of credit concern.
And the market reaction, especially in the regional banks, it was pretty quick, wasn't it?
Oh, very swift, yeah. We saw those U.S. regional bank indices. They took a sharp dive on October 17th.
Right. There was a bit of a scramble back the next day, a partial recovery maybe.
There was, but that initial plunge, that was the real signal, a definite jolt.
It put the focus squarely back on credit quality, I suppose.
Absolutely. It's the bedrock. When trust gets shaky there, investors immediately start scrutinizing a few key areas.
Which are?
Number one is just overall credit quality, especially in commercial real estate. That's CRE, and commercial and industrial loans, C&I.
Okay.
And number two, the other big one, is deposit stability. Just how solid are the bank's funding sources?
Got it. So let's start with where the pressure was most intense. Certain names got hit first, right? Who was linked directly to those disclosures and fraud concerns?
Yeah, the spotlight landed pretty hard on a couple of specific regional lenders initially. The names really feeling the heat right away were Zion's Ban Corporation, that's ticker ZION.
ZION.
And Western Alliance, ticker WAL.
WAL. And why them specifically?
Well, they were perceived as being directly linked. Either their exposures were tied to that alleged fraud, or they operated in loan books or areas that the market suddenly got worried about. Fears of similar, maybe undisclosed issues lurking.
It almost feels like, well, maybe unfair isn't the right word, but that a bank can get hit so hard just based on headlines elsewhere. What makes ZION or WAL more vulnerable than another regional in that kind of situation?
It often comes down to perception, really, and their specific mix of loans. When the market gets spooked about credit, it tends to punish banks with higher concentrations in those areas people are worried about, like C&I or CRE,
Right.
especially if they're in certain niche markets. And just the headline, even if it's not directly about their core operations, it fuels that contagion fear.
Fear of what exactly? Deposit flight.
Yeah, fear of deposit flight, worries about needing more capital later on. It just kills the valuation multiple. It's like a quick reaction.
Okay, so ZION and WAL felt that initial shock, but turbulence like this, it always pushes capital somewhere else, doesn't it? The market doesn't just sell off, it reallocates. So who tends to benefit when these credit worries flare up?
Yeah, that's right. We can sort of group the winners into, let's say, three main camps. The first one is maybe the most direct beneficiary of the instability itself. Market infrastructure and volatility plays.
Explain that. Why do exchanges do well when there's a credit scare?
It's pretty straightforward mechanics, actually. When credit risk goes up or people think it's going up, institutions hedge. They need to protect their portfolios.
Okay.
Or they start speculating more actively on things like interest rates or credit default swaps. All that activity means a big jump in derivatives trading, futures, options volumes.
And the exchanges facilitate all that.
Exactly. They provide the plumbing, the platform. So companies like CME Group, ticker CME, and Cboe Global Markets, CBOE.
CBOE. They're basically selling the shovels during a gold rush, or maybe the insurance during a storm.
That's a good way to put it, yeah. They have businesses where earnings really correlate with volatility. More fear often means more volume, which means more fees for them.
Okay, that makes sense. What's the second category of winners?
That's the classic flight to quality, money looking for a safe harbor.
Right. So when smaller regional banks are under a cloud.
Precisely. Investor money and even deposits sometimes tend to gravitate towards the really big players, the large U.S. banks with those fortress balance sheets people talk about. Their funding just looks inherently more stable.
You mentioned sticky funding profiles in the outline. What does that mean for the listener? Why are their deposits sticky?
It just means that the deposits aren't likely to suddenly vanish, even if there's some panic in the air. It's down to a few things.
Mm.
Sheer brand trust, their global reach, diversification, and also critically, many big companies use these banks for their day-to-day operational accounts. And those are much harder and slower to move than, say, retail savings.
So we're talking about the giants here.
Yeah, names like JP Morgan Chase, JPM, and Wells Fargo, WFC.
WFC. They're seen as the safe havens when worries about smaller banks bubble up.
That's generally the dynamic, yes.
Okay. But it wasn't just the huge banks that held up. You mentioned a third category, showing that even within the regional space, some did okay. The resilient regional lenders.
Yes, and this is important. It wasn't a case of all regionals being punished equally after that initial knee-jerk reaction.
So what set the resilient ones apart?
It really came down to their results and their metrics, those lenders that could show clean numbers, specifically on things like net charge-offs, NCOs, and their reserve coverage, how much they'd set aside for potential losses. And crucially, their deposit stability. If they showed strength there, they managed to bounce back much quicker as the initial sort of panic subsided. Their own numbers provided reassurance.
So strong fundamentals acted as a shield. Which names stood out there?
Well, banks like Truist Financial, TFC,
TFC.
and Fifth Third Bancorp, FITB.
FITB. Okay. They basically demonstrated that good risk management still counts, even when the whole sector is getting painted with the same brush initially.
Exactly. Quality within the group mattered.
All right, now let's swing back to the losers. We talked about ZION and WAL taking the first hit, but where did the pressure spread next? The secondary effects.
Yeah, the concern didn't just stay with those initially named banks. The next area that came under pressure was auto and subprime auto lenders.
Connecting back to those auto-related bankruptcies you mentioned earlier.
Directly, yes. When you see bankruptcies in the auto sector, it immediately raises red flags for the lenders focused there.
Why specifically? What are the main worries?
Two main things. First, you worry about recovering less money on any loans you have to repossess. Lower recovery values mean higher net charge-offs, actual losses.
Right.
And second, the market anticipates that lenders will react by tightening up their underwriting standards, making it harder to get a loan.
Which slows down future growth for them.
Exactly. Slower growth hits the valuation multiple pretty quickly.
So which companies felt that pressure?
That put names like Ally Financial, that's ALY,
Ally.
and Credit Acceptance, ticker CACC, right in the spotlight.
CACC.
Yeah.
Okay. Their growth outlook suddenly looks a bit more complicated.
Definitely. And that credit worry, it didn't stop there either. It rippled out further, hitting our third category of losers, the consumer credit issuers.
So the credit card companies, the name's really sensitive to how the average consumer is doing.
That's right, the card-centric issuers. Why are they affected? Because if there's a general sense of rising risk in the financial system, maybe fears of unemployment ticking up or default rates rising.
They have to prepare for more losses.
They do. They have to increase their loss provisions pretty substantially. That means setting aside more capital now to cover loans they expect might go bad later.
Okay.
Plus, they might pull back on marketing, trying not to acquire potentially riskier customers in an uncertain environment. Both of those things, higher provisions, lower marketing, tend to weigh on their earnings forecasts and their stock valuations.
So even though they aren't directly involved in, say, regional bank fraud or specific auto bankruptcies, they get caught in the broader downdraft of credit concerns.
Absolutely. We saw that pressure impacting names like Capital One, COF, and Discover Financial, CRS.
DFS. It just shows how interconnected it all is, doesn't it? Specific problem over here.
Can quickly force companies over there to adjust their strategy and outlook.
Yeah.
Batten down the hatches, essentially.
Okay. So we've covered the initial trigger, we've categorized the winners who benefited from the flows or the volatility, and we've traced how the pressure spread to different types of losers. Let's try and distill this down. For listeners tracking this, what are the key takeaways? What's the sort of prevailing bias now, and what should they be watching?
Well, the positioning, the sort of bias that emerged seems pretty clear. It's favoring quality, those big banks, the resilient regionals, and also those volatility beneficiaries like the exchanges. While on the other side, being much more selective, maybe even negative, on the regional banks that look weakest, the ones actually showing signs of deteriorating credit in their numbers. The market is trying to differentiate.
It's not just selling all regionals anymore.
Not after the initial shock, no. It becomes more discerning.
So beyond just watching the stock prices, what fundamental metrics are most important to monitor right now?
From a fundamentals perspective, three things are really key. First, provision builds. How much capital are banks putting aside for future loan losses? Is that number growing faster than expected?
Okay, provisions. What else?
Second, NCO trends, net charge-offs. Are actual losses ticking up? That tells you if the provisions were justified or maybe even insufficient.
Got it. NCOs. And the third.
And third is the deposit situation. Specifically, the deposit mix, are they relying more on less stable funding? And critically, the cost of those funds. If banks have to pay a lot more to keep depositors from leaving, that really squeezes their margins.
Cost of funds, right. Very important. Now, you also mentioned some market-based indicators like option skew and term structure. For listeners who aren't deep in derivatives, what can those tell us?
Sure. Option skew, basically it measures the relative price of insurance against a drop versus bets on a rise. So are puts more expensive than calls?
Okay.
If that skew spikes way up, it suggests traders are maybe panic buying downside protection, lots of fear of a sudden fall.
In the term structure.
That just looks at how that skew or volatility pricing in general changes over different time horizons, short-term versus longer-term options. It helps you judge if the fear is just immediate short-term panic or if the market is pricing in a more prolonged period of worry.
So watching for signs of panic versus maybe things calming down.
Exactly. Are things normalizing or staying elevated?
And finally, looking ahead, what are the immediate catalysts? What could change the picture quickly?
The most direct catalyst path is just the ongoing flow of bank earnings reports. Every quarterly release, every management call.
They'll be closely watched.
Intensely scrutinized. What are they saying about reserves? About their funding situation, their outlook on credit quality. That commentary is key. And, of course, any unexpected new credit events popping up, more bad loan news, another bankruptcy that could easily reset sentiment again.
Okay, that brings us towards wrapping up. We've walked through the specific names and sectors caught up in these recent credit concerns from Zion's Bank Corporation, ZION, right through to JP Morgan Chase, JPM.
Covered the winners and losers.
Yeah. So as you process this information, definitely keep a close eye on those upcoming bank earnings, and especially what management teams are saying about reserves and funding. Those really seem like the key guideposts for near-term sentiment right now.
And just the standard reminder for everyone listening, remember, this is not financial advice. We're not giving buy or sell recommendations here. This is purely the opinion of the author.
Absolutely. Always do your own research. Thanks for listening to Breaking News to Trading Moves.